In aviation, choosing between facultative and treaty reinsurance is a critical strategic move. But a paradox is shaking the market. Direct insurance rates are softening, while reinsurance premiums have climbed up to 30% yearly since 2019. And it's not just catastrophes. Small, frequent attritional claims now consume up to 2/3 of all global premiums. This proves there's no single best option. The optimal strategy balances precision against efficiency in a volatile market. We'll now dissect both options, expose the market forces, and give you the framework for a resilient reinsurance strategy. So, what are our two main tools? Let's begin with the fundamentals. Think of facultative as a scalpel and treaty as a safety net. Facultative reinsurance is risk by risk, offering pinpoint precision for unique or hazardous aviation exposures. The reinsurer can accept or reject each one. This right to reject each risk is a defining feature. It gives the reinsurer complete control, but adds uncertainty for the primary insurer. Treaty reinsurance is the opposite. It's an automatic agreement covering an entire portfolio, like an airline's hull insurance book. Facultative requires high-touch, individual negotiation per contract. Treaty is low-touch, with one agreement covering everything automatically. This efficiency makes treaty reinsurance generally less expensive on a per-policy basis. The precision of facultative coverage comes at a premium. So why pay more for facultative? It allows for surgical precision. Terms can be customized for exposures that don't fit a standard treaty. This negotiation also offers a hidden benefit: access to specialized knowledge. Reinsurers become a second set of eyes, improving risk assessment. But how does this expert-driven single-risk approach connect to the massive capacity squeeze we mentioned? We will answer that shortly. By ceding portions of massive risks, like a new jet fleet, facultative reinsurance expands an insurer's underwriting capacity. Facultative is transactional. What is the core mechanism of a treaty? It is about building a stable, long-term partnership. These relationships provide consistent support through both hard and soft market cycles. The reinsurer is a committed partner in the entire portfolio. The trade-off for this efficiency is less customization. A treaty's strength is its automatic broad protection for a large volume of similar risks. Consider the Russia-Ukraine conflict. Leased aircraft were stranded, creating sideways losses outside standard policies. This is a perfect scenario for facultative coverage, which can be constructed specifically for such a complex, non-standard risk. Other facultative uses: insuring a prototype aircraft, covering a high-profile air show, or protecting against specific airline cyber threats. And for treaty? A standard airline's hull and liability portfolio, a regional airport's premises liability, or a flight school's training fleet. In a stable world, these choices are clear. But the aviation market is facing increasing complexity from new threats and technologies. A fundamental problem is that current direct and facultative premium levels are often too low to cover potential catastrophe losses. Now for the answer to our earlier question on the capacity squeeze. Reinsurers are struggling to get their own protection, called retrocession. With the retrocession market tightening, they have less capacity to offer. This creates an excess of loss capacity squeeze for facultative placements. This squeeze explains the market divergence from our hook. As direct insurers lower rates, the reinsurers backing them face higher costs and less capacity. They must pass these costs on, causing the significant premium increases we see today. some reporting a yearly swell of up to 30%. With this intense pressure, how do you build a strategy? You must intelligently combine the strengths of both systems. First, your treaty is your foundation for predictable risks. Its efficiency is your defense against those rising attritional claims we identified earlier. Second, use facultative placement as a strategic tool. For geopolitical sideways losses and new tech risks, its precision is invaluable. By surgically removing high-severity risks via facultative placement, you stabilize your earnings and fortify your solvency position. The optimal strategy is a hybrid model. A strong treaty covers the core business, supplemented by a disciplined facultative program for volatile exposures. So, what is the best reinsurance for aviation companies? As we've seen, the best choice is not a product, but a strategy. You must manage the paradox of softening direct rates and a hardened reinsurance market, squeezed by both catastrophe and attritional claims. Success lies in matching the efficiency of treaty for predictable risks with the surgical precision of facultative for your volatile outliers. This understanding lets you shift from a reactive buyer to a strategic architect of your company's risk transfer program. Does your current reinsurance structure truly reflect your risk portfolio and the realities of today's market? Thank you for watching. Subscribe for more in-depth analysis on the insurance and reinsurance markets.